Hey folks, welcome to Zoom Out with Tozu Says. This is my Q2 2026 outlook. A long Iran war? But before we get started, remember everything presented here is not investment advice. I'm biased, I have blind spots. This is for your entertainment only. So where are we now after the US started two wars since January 2026? How's the economy? How's the stock market? The truth is, as of May 6th, stocks are at all-time highs. Corporate America is enjoying stunning profitability in Q1, and the economy and jobs market are actually quite solid. How did this happen? There are many reasons, and my clients can attest that we've enjoyed solid returns so far. But will this last? I think the rest of 2026 and into 2027 will depend on how the Iran war unfolds, how economically and geopolitically resilient the US is, and whether or not the US and China can agree to stabilize relations. First, a quick history lesson. Looking back at the COVID pandemic, we had a demand crash against baseline supply that triggered a huge global supply-demand imbalance. It resulted in massive government stimulus. Trump handed out free money and the Fed supported with plenty of QE, but eventually caused crazy inflation and forced the Fed to tighten to keep inflation in check. With the Iran war, we have a supply crash against baseline demand, triggering a global supply-demand imbalance. If the war lasts a few more months, the supply crash will become embedded. Inflation has already spiked globally, and a long war will cause panic for much of the world. I think we'll see massive government stimulus again. For the US, this time less Fed stimulus, but more fiscal/treasury stimulus. When the government steps in to help, there are always consequences. The US will likely remain solid in the mainstream economy, but Wall Street may not get enough to sustain the fantastic growth of the last few years. So, the Iran war. How will it end? According to George Friedman, a geopolitical expert, wars end in one of two ways, either by victory by one over the other or by a negotiated peace. As I'm looking at this from an investment lens, I see two scenarios: a negotiated peace agreement in May or a long war lasting 6 or more months. For me, it's more of a matter of when a resolution is achieved rather than how. If we achieve a sustainable peace agreement and reopen the Strait of Hormuz, the supply crash will be temporary and resolved in 3 months. However, a long war will cause supply shut-ins for oil production, resulting in much longer restart and repair operations before supply can recover. From the moment the strait is open again, we should expect 6 to 12 months for supply levels to recover. By then, many countries will have depleted the reserves and will be begging for any supplies at any price, causing inflation. Meanwhile, crop production is already delayed by fertilizer supplies, and a forming El Nino is causing major concerns globally. Looking at scenario 1, a peace agreement in May, I give this a 40% probability. What the US wants and what Iran wants are very far apart. The two main things the US wants are the very foundation of why Iran is still able to stand up against the US. What could the US offer that they would give up their trump cards? And could they trust the US to honor the agreement when, time and again, the US has broken its promises and gone against international norms? Sadly, I see a long negotiation process with the strait remaining practically closed in the meantime. The only wild card I see is China. If they're willing to step in and, with the US's blessings, assure Iran of support, unblocking the strait could be possible. Just ahead of the Trump-Xi summit on May 14th, Iran's foreign minister visited China. As Iran's largest trade partner, China's influence is great. Now it's up to China to decide what they want from the US and whether Trump would pay for it. This is a highly complex negotiation between the US and China, as it involves Iran, Taiwan, the Ukraine war, protective trade barriers, and the underlying US-China competition for global supremacy. Both are heavyweights. The US is clearly the only military, reserve currency, and natural resource superpower, but China doesn't need to get re-elected. They can move much faster and can concentrate their power and capital very effectively. A long war lasting 6 months or more is my base case. As both sides continue their on-again, off-again negotiations, the US has 3 strategic options while Iran only has 1. You hear in mainstream media about the possibility of Trump declaring victory, withdrawing US troops, and leaving the mess for others to clean up. I find this the least likely option. Optically, this would be a clear win for Iran and another Trump always chickens out moment for the history books. The dual blockade allows both sides to continue negotiating, with both sides hoping the other will capitulate due to growing pain points. For Iran, the loss of export income and supplies. For Trump, the political backlash of an unpopular war. Personally, I think Trump is beyond caring about the political damage. He's unlikely to be able to salvage the GOP prospects in November elections, and for his last presidency, I think he cares more about his legacy and how history will see him. Truth is, the blockade sucks for most of the rest of the world, but it's a massive boost for US exports. The US can afford to wait longer than Iran. Finally, I do see a scenario where some factions within the Pentagon and White House advocate to decisively conquer the Strait of Hormuz. Not all of Iran, but just the Strait and Karg Island. On a geopolitical chessboard, this makes making Venezuela a colony and gaining control of the Strait gives enduring outsized power to the US over China specifically, but basically the rest of the world for decades and maybe centuries. Despite the cost of lives and treasure, this prize may be too tempting to Trump. A success would definitely establish his legacy. And here's my crystal ball outlook for the rest of 2026 based on my 2 scenarios. As you can see, we're going to have global inflation, resource scarcity, falling global liquidity, and possibly negative El Nino effects on crop yields, regardless of how or when the Iran war ends. If we could come to a peace deal quickly, the effects will be temporary and could be resolved by year end. For every month the war continues, we are adding 2 to 3 months of recovery delay. On the plus side, the US will provide fiscal and monetary stimulus. Fed QE is likely to remain just enough to prevent a market collapse, while Treasury QE is likely to support the real economy. I think Republicans will lose the House and possibly the Senate as well. A gridlock Congress is a positive for the stock market, but a blue wave takeover by the Dems could also mean impeachment proceedings, bringing uncertainty. Finally, I'm bullish that the US and China will come to some agreement, stabilize trade relations, and such an agreement would also precipitate a Ukraine war ceasefire as well. Both of these would be a positive for the world. Digging into more detail, these are the factors that I'm watching to determine the second half economy and market potential, depending on long war or peace scenarios. Basically, more reds than greens, with reds in the long war scenario being more powerfully negative. I want to highlight my forecast that unemployment remains low and business activity is mildly positive, depending on sector. The US economy looks decent to me in either scenario. You know I'm big into tracking global liquidity. Here's a recent chart produced by Cross-Border Capital. We have clearly peaked and are likely to be searching for support levels over the next year or so. How deep will it go? What might trigger the Fed and or other central banks to restart QE in earnest? I can imagine if the Iran war keeps going, it'll trigger an earlier incentive for stimulus and maybe the shallower support level. We will see. Just an aside, the US and China are the biggest economies in the world and also have the biggest impact on global liquidity. The US liquidity cycle has peaked, but China's has recently been counter-cyclical to the US. Their liquidity injection in Q1 were negative, but will that change? Maybe they're waiting for a Trump agreement to pump the gas. If that were to happen, we would need to consider allocating investments to where there is money. Here I've listed what I see are the headwinds and tailwinds for the US. My conclusion is there will be no US recession, regardless of the Iran war. The inflation negatives are limited by the US's superior natural resources, while government stimulus in all forms is, well, stimulative. The key point, however, is the form of stimulus. This time, money created will more likely enter the real economy rather than the financial economy, which supports Main Street over Wall Street. Just the AI build-out alone will be worth $800 billion directly and will create economic value in the trillions. This will offset declines in other sectors and should net out to a positive U.S. economy. As a bit of proof, Q1 GDP grew at about 2%. When you break down the components driving this growth, 75% came from a massive AI infrastructure build-out. Looking ahead, Morgan Stanley recently raised their CapEx forecast for the AI build-out and now expects over $1 trillion for 2027 and 2028. This foundational spending can anchor the U.S. economy for several years. Of course, it's not all roses. The U.S. has a debt problem, and despite Trump's pledge to reduce the budget deficit, wars are expensive and will likely increase the budget deficit over the coming years. If we think about U.S. spending like a credit card based on U.S. treasuries, we know that the more you spend, the more you owe. When your outstanding balance is high, if you don't pay it off, you pay more interest. To further complicate things, U.S. treasuries have different maturity dates, like CDs. Some come due in a month, others in 5, 10, 20, or 30 years. As you can see in the chart below, we have a spike of $8 trillion plus of U.S. treasuries coming due in 2026. It's Treasury Secretary Bessent's job to make sure that the U.S. Treasuries markets run smoothly, that there are more buyers than sellers, more demand than supply. With the budget deficit likely rising, there's now also more supply in 2026. Who is he going to sell this to? I think Bessent is one of the few adults in the room and will figure it out, but it won't be easy. Having said that, the U.S. is in a comparably better fiscal condition than most of Europe, China, Japan, Canada, etc. For all the gloom and doom on social media, the U.S. is not going to collapse anytime soon. So the MOVE index is the volatility index specifically for the U.S. Treasuries. We would think that with the Iran war going on and inflation expectations rising, that U.S. Treasuries would be more volatile. Instead, we see a sudden drop. This looks like intervention, probably executed through timely Treasury buybacks that Bessent has been doing. By keeping the MOVE index from spiking, Bessent is calming the banking industry, allowing them to function and lend normally despite the war. I think there will be more interventions from Bessent in the future. In aggregate, this is my best guess, emphasizing guess, for 2026 money supply and money demand. Now, there's some big IPOs slated for this summer, including companies like SpaceX, OpenAI, etc., which could draw up to $3 trillion of cash. Meanwhile, the AI build-out, originally funded by the deep pockets of big tech, have now moved to the bond market, where big tech is now selling bonds to pay for the continuing capex. That's estimated to draw about $2 trillion of cash. As from the previous chart, 8 to 9 trillion of treasuries will mature in 2026, so the U.S. will need to issue 8 to 9 trillion of new treasuries to roll over that debt. But since the budget deficit is likely to go up with war spending, we may need an additional trillion of new treasuries to make the math work. All in, about 15 trillion of money demand. On the flip side, the Fed will pump in about 500 billion from its continuing QE program. Recent ESLR bank deregulation has freed up 1 to 2 trillion of capital from the banking industry, and Treasury QE could provide another trillion, and rolling over 8 to 9 trillion of maturing treasuries will round out the total supply to about 11.5 trillion. So here's the rub. If money supply is less than money demand, someone gets left out in this financial musical chairs. In this environment, money is scarce, so we will demand higher quality and higher returns. Those who don't get a chair could end up on the street. This is why I keep saying the U.S. liquidity cycle is falling. There's less money for the demand. Outside of the U.S., it all depends on whether or not you're a country that has natural resources or are dependent on importing natural resources to run your economy. North and South America are relatively speaking resource rich. Europe and China, not so much. Island nations tend to be very dependent on imports to survive, making most of Asia at risk. Serious headwinds are inflation, scarcity, falling liquidity, aging demographics, and high debt levels. Meanwhile, those nations who can export an important resource will be able to survive, maybe even profit. Given the New World Order, according to Trump, the US is no longer the guarantor of peace and freedom, and the world is scrambling to enact national security policies in defense, technology, and natural resources, which should enjoy long-term policy tailwinds. Right now, rising inflation expectations are forcing central banks around the world to consider rate hikes if inflation persists. This is an economic negative, as rate hikes tend to be a brake on economic growth. But remember that interest rates are only one policy tool. The other is QE, and I would expect the major central banks reviving their QE programs if economic growth stalls. Maybe in 2027? Aging demographics is another global headwind. For many economies, young people pay for retired old people. Back when Social Security was created, 10 young people paid for one old person who typically died by 65. Today, in many countries, we are looking at 2 to 3 young people taking on the burden of paying for one old person who is living to 80. It's not hard to see that the math doesn't work well, and young people have less money to spend on themselves. Ergo, everything is too expensive, and nobody wants to create more young people. Maybe this is a good thing with the coming abundance of labor in the form of smart robots, but during this transition period, it'll be painful for many, a drag on economic vitality, and polarizing for politics. Most countries, instead of making painful and unpopular cuts to entitlements, opt to keep the lights on by just printing up more money and issuing more debt. They don't need voter approval to kick the can for others to deal with. With global debt at all-time highs and a war that is putting real stress on global natural resources, there's a real risk that something breaks in the near future. One of my favorite quotes is, "Hunger eats civilization." As some nations face hardship, it is normal in human history that violence can follow. And if you happen to have a security alliance, conflicts can spread. We have actually seen a slow decline in GDP globally since 2022, despite US stocks doing gangbusters. Yes, we are fortunate to have the leaders in AI in the US, but outside of the tech sector, economic growth is rather stagnant. I think it'll be a tough slog into 2030 for the world as we work through serious geopolitical issues and figure out how humanity is going to survive in a world of AI and robots. Now about food. Historically, oil prices lead food prices. If the recent spike in oil prices continues this correlation, food prices should rise precipitously as well. Professional investors are already positioning themselves for higher food prices. Pricey fertilizer due to the Iran war and a developing El Nino weather pattern could become a double whammy that drastically hurts global food supply. El Nino and La Nina events have global repercussions. For the US, El Nino tends to bring high heat and less moisture to America's breadbasket region. The US typically produces more than it needs and exports its grains, but El Nino will also affect South American, Europe, Russian, and Asian crop yields. As agricultural goods are a global market, everyone will feel the inflation. UBS is warning of 1930s Dust Bowl-like conditions for this summer, while others are watching carefully for signs the El Nino develops into a super El Nino. This is definitely worth monitoring. Many countries need grain imports to survive, so they are particularly at risk of famine and social unrest. To wrap it up, here are my investment themes for the second half of 2026. With falling global liquidity and the unique nature of Besant's Treasury QE, more money will flow into the real economy over the financial economy. If we get a peace deal with Iran, I think the US stock market will churn sideways. But if we have a long war, I think the US stock market could experience downward momentum. Irrespective of how the war ends, governments around the world will set policy and spend money on defense, commodities, technology, and national security. They'll likely print money to do this, causing more currency debasement and even higher debt. Although the broad US stock market may stay range-bound, some sectors will definitely outperform others, and international markets could continue to outperform the US, especially if the US dollar were to resume its weakening trend. Having a bit more cash is a good idea, but being 100% in cash would be foolish. Better to invest with the tailwinds of this era, and I hope the sectors I highlighted in green will turn out to be prescient. Happy investing. All right, that's all for now. Hope you've been entertained and moved to think. Thanks again for watching, and feel free to share this video and reach out to me with your thoughts and questions. Happy trading.